Hi everyone, welcome back to Corporate Decoder. Today we're diving into the world of Sensei Biotherapeutics. No, they don't sell healing crystals, but they did ask their investors to vote on something that could heal their stock price, or leave it in even worse shape. This report is about what happened at their annual meeting, including a vote that could let them do something called a reverse stock split. We'll explain what that is and what it might mean for you if you own their stock. If you're interested in unraveling company reports like this, make sure to subscribe. Also join our Discord community, linked in the description below, to discuss these topics with other investors. So, on May 21 of 2025, Sensei Biotherapeutics held their annual meeting where shareholders got to vote on some important issues. About 66% of the shares were represented at the meeting, either in person or by proxy, meaning someone voted on their behalf. The first vote was about electing members to the board of directors who are like the team captains for the company. William Ringo got about 9 million votes for him and about 962,000 votes were withheld, meaning those voters didn't support him. John Salibi got about 9.2 million votes for him and about 662,000 votes withheld. Both were elected to the board. The second vote was to ratify the appointment, which means approving of Deloitte and Toussel as their independent accounting firm for the year. About 15.8 million votes were cast in favour, about 370,000 votes against, and around 446,000 abstained, meaning they didn't vote either way. So, the appointment was approved. Here's where it gets interesting. The third vote was about allowing the company to do something called a reverse stock split. About 14.7 million voted for this, 1.6 million voted against, and about 321,000 abstained. This proposal was approved. So, what is a reverse stock split? Well, imagine you have a pizza cut into 30 slices. A reverse stock split is like taking those 30 small slices and combining them to make 10 bigger slices. You still have the same amount of pizza, but now it's in fewer, larger pieces. In the stock market, it means the company reduces the number of its shares and increases the price of each remaining share. In this case, Sensei Biotherapeutics asked for the option to do a reverse stock split at a ratio between 1-for-10 and 1-for-30. Let's say they chose 1-for-10. If you owned 100 shares of their stock, after the split, you'd only own 10 shares. But the price of each of those 10 shares would be 10 times higher than before. Why would a company do this? Usually it's because their stock price is very low, sometimes even below $1 per share. Many stock exchanges like the Nasdaq, where Sensei is listed, have rules about minimum share prices. If a stock stays too low for too long, the exchange might delist it, meaning the company's stock can no longer be traded on that exchange. A reverse stock split can help a company avoid delisting by artificially boosting the share price. It can also make the stock look more attractive to some investors who might see a low stock price as a sign of trouble, but it's not always a good thing. A reverse stock split doesn't change the underlying value of the company. If the company's business is still struggling, the stock price could fall again even after the split, and some investors see reverse stock splits as a sign of desperation, which can further hurt the stock's reputation. In summary, Sensei Biotherapeutics got approval to do a reverse stock split, but it's up to their board of directors to decide if and when to do it. Now, let's step back and look at the bigger picture. Sensei Biotherapeutics is a company trying to develop new cancer treatments. The biotech industry is tough with lots of risks and competition. The fact that Sensei is considering a reverse stock split suggests they're facing some challenges. Their stock price is likely low enough that they're worried about being delisted. This could be due to a number of factors such as disappointing clinical trial results, financial difficulties, or just overall market conditions. The reverse stock split itself won't fix these problems. It's more like a band-aid solution. The company needs to show real progress in its drug development pipeline and improve its financial situation to create long-term value for shareholders. However, it's not all doom and gloom. Sensei Biotherapeutics is working in a promising field, and if they can successfully develop and bring new cancer treatments to market, they could still be a rewarding investment. The risks are significant, but the potential rewards are also high. Investors should carefully weigh the pros and cons before investing in a company like this, especially when they're considering a reverse stock split. Alright, that's our analysis of Sensei Biotherapeutics' recent filing. What do you think about their decision to seek approval for a reverse stock split? Is it a smart move or a sign of deeper problems? Share your thoughts in the comments below. If you found this video helpful, please give it a like and subscribe to our channel for more in-depth analysis of corporate filings, and don't forget to join our Discord community in the description below to continue the conversation. Thanks for watching, and we'll see you in the next video.